Hello, welcome to our Tulane University Spring 2017 Burke and Road Report. This investor presentation is our continuing coverage of Amerisafe Incorporated. Analysts on this project were Ryan Hogan, Srinivas Korapati, and Dave Hand. Let's run through what we'll cover in this presentation. This is an agenda of the topics we'll be covering today. We'll begin by giving our analyst valuation of Amerisafe, discussing background information and industry analysis, and then conclude with our investment thesis. Our analysts have assigned a 12-month target price of $70 by using two valuation methods, a dividend discount model and a discounted cash flow model. The dividend discount model predicts dividends and discounts them to present value, while the discounted cash flow model incorporates expectations of Amerisafe's operational activities. For both valuation models, we determined an appropriate weighted average cost of capital to be 7.56%. We calculated our weighted average cost of capital by comparing the volatility of the company's stock relative to the S&P 500 over the past 50 months. Then, we used the capital asset pricing model and calculated a 6.56% cost of equity. Our analysts determined that equity risk was the only relevant risk factor in calculating the weighted average cost of capital because Amerisafe carries no interest-bearing debt. Most of the company's liabilities are held on account in the form of cash for potential future payouts. Due to the company's small market capitalization and low trading volume, we applied a 1% liquidity premium, which resulted in a 7.56% discount rate. We then assumed a terminal value growth rate of 3% in both of our models. With this approach, the dividend discount model predicted a target price of $68.74, and our discounted cash flow model predicted a target price of $70.94. We took an equal weighting of these two valuation models to arrive at our 12-month target price of $70 per share. The two bars on this graph represent each of our valuation models. The dotted line shows Amerisafe's current share price of $66.45, while the orange line displays our 12-month target price of $70. For more details on our methodology and assumptions, please review our written report available on the Burke and Road Reports website. What makes Amerisafe special is that they only offer workers' compensation insurance to employers in hazardous industries. So how did Amerisafe get started? Headquartered in DeRidder, Louisiana, Amerisafe was founded in 1985 as a workers' compensation provider to employers in the logging industry. Amerisafe actively markets workers' compensation policies in 27 states and has a small amount of premiums in 20 other states. The company sells its policies through a network of over 3,000 independent agencies and its subsidiary, Amerisafe General Agency. The company covers employers in a wide range of hazardous industries, including construction, trucking, manufacturing, agriculture, oil and gas, logging, and maritime. Although underwriting workers' compensation to employers in hazardous industries carries a high degree of risk due to the severity of the claims, the frequency of the claims tends to be lower than the frequency of claims associated with non-hazardous industries. Amerisafe employs a team of safety inspectors with industry experience to conduct comprehensive workplace safety reviews prior to offering quotes. These safety experts also help Amerisafe's existing customers improve their safety standards. Amerisafe's success is based on a disciplined underwriting strategy, which is focused on underwriting profitability and risk selection. This allows Amerisafe to operate in a niche segment of the insurance industry that most competitors avoid.
The size of the workers' compensation industry is commonly measured by the amount of net premiums written by industry participants. The workers' compensation industry moves in cycles, which are typically described in terms of softening and hardening. A softening market is characterized by an increased number of competitors due to periods of high profitability in the industry. As competition increases, underwriters are forced to reduce premiums or assume greater risk in order to remain competitive. In 2014, a firm market drove many multi-line carriers to re-enter the workers' compensation segment, which has led to the present softening of the market. Although switching costs for employers are relatively low, Amerisafe's long-term relationships and safety services allow the company to continue focusing on risk selection and customer retention. Amerisafe has managed to retain nearly 90% of its voluntary business over the last 10 years. Amerisafe continues to remain profitable, despite downward pressure on premium prices. The company benefits from positive trends in economic growth, rising employment, and the decreasing frequency of major workplace injury. The most important metric in the workers' compensation industry to measure profitability is the combined ratio, which can be understood as the total losses and expenses divided by earned premiums. Typically expressed as a percentage, a ratio below 100% indicates that a company is generating a profit from underwriting, while a ratio over 100% indicates that profitability must be reached through investment income. As of December 31st, 2015, Amerisafe had a 5-year average combined ratio of 80.1%, which, as the chart shows, is the lowest among its competitor group. Regulations in the insurance industry limit companies to low-risk investments, such as municipal bonds and highly rated corporate bonds. As this chart indicates, Amerisafe mostly holds bonds held to maturity. The return on these investments closely mirrors the yield on the 10-year U.S. Treasury note. The low yield on the 10-year Treasury note will continue to limit Amerisafe's investment income. So our analysts expect the company to maintain its focus on underwriting profitability and risk selection. Amerisafe does not carry any interest-bearing debt, which will allow the company to maintain its conservative approach and allow it to pay investors substantial dividends regardless of the market cycle. The Burke and Road reports are produced solely as part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decisions. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.